Hi, my name is Amy. Thank you very much for watching, and let's make some bad financial decisions together. This is for entertainment purposes only, so if you're entertained, please like and subscribe. I'd really appreciate it. And so today, I'd like to talk to you about what I've been tracking with XDTE and if I could beat it on my own using my own options and how this has evolved my opinion. And of course, this is the first week that I've been tracking, so we'll do this for a few more. We'll probably do it into the new year because there's just a bunch of like holidays and stuff, and it's kind of a super weird time, but it gets me into the habit of doing this, so we've got that going for us, which is nice. So it's always been my opinion that high income ETFs are, well, they're for people that either don't have enough money in their portfolio to dedicate towards one of these strategies, so they want the fractional distribution, or just like, I don't want to deal with my own strike prices, so it's okay for me to pay someone that does this professionally to do it for me. However, we sometimes see online people having questions about like how sustainable is Roundhill or Yield Max or any of these high income ETFs, and like, is it better or is it worse than doing it yourself? And if I don't have experience doing it myself, how can I have an opinion on like what is the return going to be like? And paper trading is not the same as actually implementing it at my skill level, what I'm doing right now. So what you're going to see here is I've been doing put spreads, which is actually close to what Defiance does, but I do like XDTE better than the Defiance. I think it's WDTE at this point. I do like it better. Anyways, I only had $600 of collateral, so I was only using $600 at one time. That was 3 contracts with $200 spreads, and I got $76.70 of premium, which is about 12 cents per dollar of collateral. And then for the covered call, I paid $9,470 for the leap, and I made $121.86 from, I got that as the distribution from that. So I got 0.0128 per dollar that I spent to get that leap. And then I wanted to do this comparison again. If I got the $76.70, but I actually paid full price for 100 shares of SPY, that would be $59,600. Yes, that's how you say that. Anyways, and then that would be like 0.0012 per dollar that I had to use to buy the share. So this week it was announced that the distribution for XDTE is 0.64 cents. So this week in particular, the cover call and my cover call, or like their distribution per dollar, is basically the same as my covered call. However, with a leap, there's 2 ways to make money. One is through your short calls, which is like your 0 day to expiration calls for in the instance of Roundhill, and then the actual contract you bought, the leap itself. So like, this isn't even the full profit that I got from this strategy. Also, I would just like to point out that 0.64 cents is not the usual is actually, I always say it's like 0.25. So in that case, like, we're doing much better with the leap and the spread, but we're like, doing it on my own would be worse if I had paid full price for all the shares in the SPY and my cost basis was pretty like at the market at the moment. So take that as you will. I am not an expert on this. Actually, let me walk you through how I usually do this. So this is roughly a week out. Wednesday is Christmas, so the market's not open. But basically, I just scroll to the bottom and I'm like, okay, well, I can't make, my goal is to, when I close it for $5, to have made $6 per trade. So, and I'm also trying to get as far out of the money as possible. And I say 0.85 delta, but I'm usually closer to like, 0.95. So we're getting closer just to like the spread here is more acceptable to me. So like we do 0.65 and 0.58. That's only $9, right? We did this and we did this, and that's $13. That's at a 0.91 delta. I would probably I'd go for this one. So like we're even further out of the money and we do this, and the difference between taking $600 and investing in XDTE and then taking, well, I mean, this is $300. So it would just be like 2 contracts here. But if the trade goes bad, and I'm using put spreads, so if it goes from $605 to $585, then, you know, I'm losing money. And if it goes below $583, I've lost all my money minus the premium, which is only, you know, $13, not even. But because this is December 26th, it's currently, you know, a week before that, and this is like, it has to drop quite a bit. Like if it becomes like $591, I'm probably going to sell out of this position, because I would rather preemptively lose $20 to $30, $40 as opposed to losing $300, which is the max amount I can lose on this trade. So, I mean, even at 0.91, even if it was at 0.96 or whatever, you're going to lose at some point. The market's going to really correct at some point. But hopefully it doesn't make a habit of doing that to me. And I've also noticed, just like as an aside, with credit spreads and the fact that I don't really want to go above like $200 to $300 in my spread. Like if I'm getting less than $20, $30, I would rather just put it on the SPY. The SPY only has an IV of like 20% as opposed to everything else, which seems to have over 100% IV right now. So but like, what can we conclude from this? It depends on like what your risk tolerance is. Do you how much do you want to manage your own strikes and your own options? Because I actually quite like, and it looks a little chaotic, but I like just putting out one call and making that, you know, $200 to $300 bet once. But I don't know how I would feel about having like this credit spread out and it'd be like 20 contracts. So for me, because I've always said that, like, if I put $600 into XDTE, I'm only getting $2.82 for the first week instead of $76.70. However, if SPY really dives and this price share becomes like $35, I still own, in this scenario, 11.28 shares. And the price could eventually recover, but in the meantime, I'm still getting distributions. So I still own the same amount of shares until I sell. And I'm still making an income no matter what the NAV is. So in that way, I really don't mind paying someone that's a professional to do a service that I benefit from. But if there is a way to use $600 to make more money than what a typically safe fund is, yeah, you can do your own put spreads on the SPY. And you can do 0-day expiration call spreads. You can do put spreads. You can do it a week out. You can do it a month out. You can do it next quarter. Just putting it the furthest out that you can. Although I'll say that, like, by putting it out by just 1 week here, if I'm losing and I have to roll my position, they do dailies really far into the future, so it wouldn't be that bad for me to more or less roll the position into a situation where I haven't actually lost money. So take that as you will. Giving yourself more time and further out of the money just gives you more time to manage the risk yourself. And hopefully, like, just not have to worry about getting caught in it too much. But I was kind of surprised because I'm not particularly good at options yet. I'm still learning that I did so well compared to XT. Like, they're professionals and they know what they're doing. So, yeah. What is your opinion on this? Do you do your own options, and how much of your portfolio is in high income ETFs? Because I'm slowly coming to the conclusion that, like, I will run options, and the premium I get from the options I will put into high income ETFs. And when I get enough distributions from those high income ETFs, then I'll consider putting out more options. But doing puts, or like not doing spreads, is safer. But only something like Elite, where I'm paying a lot less money for 100 shares, is actually, more efficient than Roundhill. If you are just paying for the amount of shares and doing your own calls on them, then you may as well use the expertise of Roundhill because you're getting more money from Roundhill. So anyways, I just wanted to go over that and let me know what you think. Bye.